What's up, YouTube? This is Todd Horst here with TastyTracker.com. Today I'm going to talk about how I day trade. First, I just wanted to say I'm by no means an expert. I've been doing this for a couple months now. I have been successful, so I'm just really going over what I've done to be successful. It has been an evolving process, of course, and probably the biggest takeaway you can have is day trading is something that you have to learn how to do. I feel like swing trading is something that you can follow a couple bullet points and that somebody else gives you and still be successful. Obviously, you can still screw that up too, but it takes a little bit less practice and precision, where it's really just following steps and sticking to the rules that you set for yourself. With day trading, you have that as well, but you need to practice the precision and you need to be quick. Um, at least the way I've been doing it. I'm mainly just scalping trades in the morning, looking for a quick 25%. So on my swing account, you'll see either no progress being made over the day, or it'll go up or down, the value of your position. And then the next day, it'll do the opposite. And so just that constant lack of progress is what annoyed me with stocks in general. And you still get that with swing trading. It's not as bad with options because of the leverage. But day trading is different because your position is, if you do it correctly, is only going to go one direction, and then you're going to close it out. So anyway, let's get started. I said in previous videos, I'm really looking for $40 profit net at the end of each day from $300 or $500, somewhere in that range. So that's a 13% daily income. So, I mean, think about that for 1 second. That is crazy. That's daily percentage gain. And yes, it's a small amount, but the market on a annual basis is giving you 7%. So there's no point in going crazy. I know your tendency is to want to get as much money as you can, but be a little bit realistic here. 13% is still absolutely crazy to make on a daily basis. It is possible, but when you shoot, the higher you shoot, yes, you will be successful some days and you'll make crazy. Like I said last week, I had made, what was it, 272 one day or something like that, 278 in one day off of initial $400 or $500. So I had made 50% in one day, basically. And again, that's not a whole lot of money, both invested and made, but the point is 50%, I really pushed it that day. And then, of course, what would happen the following 2 days, I tried to push it and wasn't as successful. On the Thursday, I had lost not as much as I had made on Wednesday, but I still lost a decent amount. And then on Friday, I basically broke even. So what's better, having inconsistency or having consistent growth? And I think most people will agree, especially if you're thinking level-headed, that the consistent 13% is still much, much better, especially if you're going to end up blowing up your account, which is what most people do when they push it. But once you hit that, whatever your target is, for me it's 40, you just need to stop and count your blessings. I have there that you made it that far and you were successful. The other thing I say is if you hit 10 o'clock, even at 9:45, if I don't have a good position on, I'm really at that point looking to close out any positions that I have open. I'm not going to close them out if they haven't reached my target, but I'm not looking to open up any new positions because that's just too late in the morning. And even though that's only the first half hour, the volume, you can look at it minute by minute, it drops off drastically. So do you really want to be getting into a position that is not liquid enough for you to get out? It's not moving enough. People aren't interested in it. So again, even if it moves the direction you want it to, there's not enough to get the value out that you're looking to get. So yeah, 10 o'clock, just get out or stop opening up new positions. So my next bullet point here is confidence in your play. It really means a lot, in my opinion, because when you put on a position and you are unsure whether it's going to work or not, then your tendency is to close it early, and maybe you close it and 2 minutes later it comes back into being profitable or at least breaking even. So this is one reason why following people's trades doesn't work. Not only are you getting the trade delayed from when that person actually put it in, but you're blindly following what they're doing, and so you don't know what they were thinking when they opened it, and so you're not going to be as confident, and maybe you close it too soon, maybe you close it too late, whatever. Um, I have a small note here. Waiting 3 days a lot of times will um, allow that position that goes against you to come back into, again, either breaking even or profit. Um, However, a lot of times, um, if you wait that long or longer, it's completely gone to max loss. So I definitely wouldn't do anything that's expiring this week. I wouldn't wait. And I'm leaning more and more every day towards just closing out all my positions. Actually, this whole week I've just been closing out at the end of the day, not holding anything, because when you're entering that position, you weren't intending on making it a swing. So when you do make it a swing, it ends up backfiring on you more times than not. Um, and then, but if you look at the swing and you determine, yeah, it probably will go my way, um, it, it's not just the direction that you have to get, because you're buying these theta is, and there's no time basically left on the expiration. Theta is working against you so fast that it really has to be a large move in your direction. um, so if you are right, I would definitely just recommend getting out, breaking even, um, and not really trying to make the 25% or whatever on the positions that you do have to swing. But I guess the last bullet point here, what I'm trying to say is, when you're swinging a position, you're trying to project where the underlying is going to be in 30 or 45 days or 60 days or whatever, because you're choosing an expiration far out. So you're trying to predict where it's going to be or not be. Um, with day trading, you don't really have to know or care about as much the overarching thing, and even it could be going up on the day, but it's just going to have a slight pullback before it continues going up. I've profited where I bought a call on the way up, closed it, then bought a put on the pullback, and then closed that, and then bought another call to go back up. So I've done that on multiple instances. So I'm not even really playing the long-term direction at all. I'm just correctly identifying where it's at in that moment of time. The key there is to know when the when it's going to flip. So get your 10 or 15% out and don't get greedy. If you're trying to do what I just said there with the up and down, you're not going to get 60% on those plays. So don't put that as your sell limit. Put it at 15%, get the 15%, and then it'll probably be another minute there that you could have eked out a little bit more profit, but that's okay. And you're watching for the turnaround, and then you can put that position on. But really, the last point here, the last line is, nothing about the strikes that you choose really even matters. The break even you would calculate on it swinging, that doesn't matter. Um, the reality of where the underlying is going to go, where it's been, none of that matters. The strike could be way too far, and you're thinking, there's no way that this strike would ever be relevant. And or the percentage in the money is too low. Nobody cares about that. It's actually pretty interesting. Um, there's strikes that I would say if I was playing this reasonably, I would never ever buy this call because I truly don't believe that the underlying can get to that. Um, but but the reality is that the value of that strike will go up if the underlying keeps moving in that direction. So I'm talking about calls here. So if you buy a 110 call and your stock, excuse me, is at 100, but really the max you could ever see going up to is 103. The 110 will still increase in value, even though basically anybody would know that it's not going up to 110. So it just sort of baffles me a little bit. Um, but you can definitely make money off of those uh, further out strikes that realistically everybody knows aren't going to be hit, but for some reason, because the rest of the strikes are moving up. Now, as I said before, because those are further out compared to 103, they're not going to increase in value as much as the 103 strike would, obviously. But even if you're talking about the 105 strike, it's still not in the money, but um, but it's closer to the 103 that the stock is now trading at than the 110 is. So it's going to be increasing at a much faster pace. But anyway, moving on. I talked about, I think, before each play being around $100. Um, I, I mean, even $50 is a little too small for me to make it worth it with commissions. But if you're starting with a $300 or $500 account and you have $100 per play, that means you're buying a call that's around $100, or you're buying a put that's around $100, and you're looking for the value to increase by 25%. So you're looking to sell those back to close out the position at 125. Um, if you're doing 50, to get it up to the $100 price range, then you can just buy 2 contracts. So in our scenario here where we have $300, that gives you 3 attempts before you blow up your account, assuming those go to full loss, which that's another thing. I wouldn't recommend you go the whole way to full loss. Sometimes it happens if it's moving really quickly. But yeah, so keeping your price per play at between 5 and 10 plays is what I like best. So say you have $2,000, then doing a $200 play gives you 10 plays before you can blow up your account. And once you get better at it, you're not going to go 10 plays in a row losing. So and you're not going to let those all be full losses. So that's a pretty acceptable for me. Maybe you're different. I talked about this before. The higher priced underlining means you have to go either a closer expiration or further out of the money strikes, which they'll increase in value less quickly than the ones that are closer. So if the strikes are further out, if it's closer expiration, then those are going to be doing wild swings where you could be up by a little bit 1 minute, and then the next minute you're down by quite a big margin. So my next bullet point here really is that the 5 to 7 expiration is my personal favorite. So I definitely don't want to trade this Friday's expiration past Wednesday. So Monday, Tuesday, Wednesday, I'll trade this Friday's expiration, and then Thursday and Friday, I'll trade next Friday's expiration. And again, that means that it's going to be a little bit harder to get such a large percentage, but it also gives you a little bit more time to be right. And if you are wrong, you're going to lose your money less quickly than if it had been this Friday's expiration. Let's see. I in the middle there I say 1 minute. That's the chart that you're on, which I talk about that in another slide. Okay. So aiming for 5 to 25%. I mean, honestly, I'm always aiming for 20 or 25%. The better you get at it, the better you'll be able to predict how big of a move it's going to be. And the further on through the day you get, the less percentage. So if you put a play on at 9:40, you have a pretty good chance of getting 25%. By 10 o'clock, you're looking at like a 10% gain on those. And by 12 o'clock, you'll be lucky if you can get a 5% gain. Obviously, this isn't always the case. I'm just saying generically speaking here. That's been my experience. And then you need to be quick at adjusting. I like to put in a sell limit so that way if it hits it, I can just get out. Um, but if you're really quick, you can just not do a sell limit or a stop loss and just let your winners run as far as you can. I probably really wouldn't go above 60 and 100%. I would definitely sell. That's gains. But I typically do 20 to 30% gains. And if I hit it and it looks like there's still room to go, occasionally I'll open it up again. But a lot of times, that's like a 50-50 shot. The second time I open up a position that I had open and closed on a sell limit, the second time it's 50-50 whether it will win or not. So honestly, it's best if you just be thankful again that you made the 25-30% and you move on with your life. As far as the stop loss is concerned, I think selling at 30 and 40% loss is a reasonable amount. By 40, that's a pretty good indication that you called the direction wrong. 30 is sort of on the border for me. I've had a lot go to 30 and then come back either to break even or even go to a 30% win, especially with like Amazon. I have some smaller calls that I've done there, and Amazon just moves quickly, so it's not really uncommon for me to see 30. But yeah, at a 40%, you probably want to close it definitely at 50, unless you really believe in the position that you had is going to come back around. But usually the time it takes to get to 30% loss means that you either had a really bad entry, which you need to work on your entries, or it's just going against you, and by the time it hit that, it's further on in the day, and you're not going to have enough volume, even if it does come back to get out. So, yeah, I would just close it out. And again, I'll prefer to close at a 0 or a small loss over holding. You can hold, but between theta and never knowing what news is going to come out or what direction they're going to head tomorrow, it's better to just take the loss that day, and you need to accept the fact that you're not going to win everything. Okay, so now we're talking about it at the end of the week. Any profits that you do have, I suggest you cash out. Yes, you can continue to build up the pot, and honestly, the longer you do it and the more experience you get, by all means, then I would. But any success you're having at first, I would take out and put back into your bank account. That way, next week you're not having a good week and you end up blowing your account up or, having a drawdown. Then you can pull that money back out from your savings account and not have to continually add money to it. But the whole point is to not blow it on a stupid play that is such a long shot, you're not going to win. I'd rather you spend it on something tangible, go get yourself a new pair of shoes, and then you have something to show for your hard work. Too many times you have a good win, and then the next play you end up losing it. So I think taking it out encourages you to make good decisions about your trading. You can also move to a less risky swinging account. So like I've said before, I have 3 accounts. I might take it from my day trading account and put it over to my personal swinging account, just to grow that at a little bit slower pace. And, people are into dividend stock investing, that kind of thing. Sure. I don't do that, but I definitely see the value in it, and it is going to be more stable, especially if you're choosing your dividend stocks appropriately. So anyway, back to day trading. The key here is going with the trend. Swinging, sometimes I'll be contrarian, other times I'll go with the trend. But definitely, there's no question with day trading, you need to go with the trend. You can use RSI. You can check the sentiment of the market using Webull or any of your other platforms. You can use MACD for strength. Really, any indicator works, but obviously RSI and MACD are very, very common for people to use. And as I've talked before about self-fulfilling, if other people are using these, then you need to be using them as well. So that way um, you can predict what's happening. It's self-fulfilling. If the entire market is using MACD and sees it's at a top, then you'll see that it's a top, and then that's when everybody's going to start selling. So you have to be in tune with what the market's doing. So I'm watching the daily chart, 1 day, 1 minute chart. Sometimes the chart will look negative, but it's still up on the day. So the chart is a downward slant to it, but you then look at the percentage increase and it's still up on 4 or 5% on the day because of a gap up overnight or whatever. Ideally, the trend of the stock that day and the percentage are lined up. So they're both up, then you're doing a call. Obviously, if they're both down, then you're doing a put. But if one is up and one is down, what do? Sometimes the gap up was an overreaction, and so then it's going to fall. But other times, it'll continue to gap up during the day. So I don't prefer. I don't like when they're disagreeing. If they're agreeing, then you're going to have a much better trend line the entire day. It's a much cleaner play, so it's way more predictable. Obviously, you can get lucky on opposites, but it's just a lot better if they align. Okay, so the the last bullet point here is just some tidbits I've learned. Before I said about doing 4 trades and one of them is probably going to lose, and I continue to sort of reduce that, and now I'm really down to 1 or 2 trades per day, and I'm really just honing in on which one I think is going to be the best. And I wouldn't say I put all my eggs in one basket because I still stick to the $100 rule, but I'm choosing 2 plays at $100 and having them both be successful, as opposed to choosing that one loser and that knocking out all the gains. So if you're really pushing too hard, your gains can outpace your losses can outpace your gains. And then mobile trading, I can mobile trade for my swing accounts, and I tried doing that for day trading, and it just turns out to be way too much to try to toggle in between thinkorswim on your mobile and then on back to Tastyworks, which is who I actually use for my brokerage. But thinkorswim has better charts, so whatever your charting software is that you like to use on mobile, you're constantly switching back and forth, and the market's moving too quickly to be able to put in your orders quick enough. Whereas if you're doing a desktop, you can have 2 or 3 monitors set up and have your chart on one monitor and your Tastyworks broker or whatever on your other monitor, and you have a better picture. You can see them both happening at the same time. And obviously being awake, since it's requires a lot of attention, I think, to identify and be mentally present. You can't sort of walk in and be dazed, think you're going to do well. So if you're not feeling well on the day, it's just better to skip the day. There's always tomorrow. I know that's easier said than done, but it is definitely better to not take trades that just because you feel like you need to. So I have a couple quick examples here, just to McDonald's, and then this is an actual trade I played. So you can see you can barely see it over here in the corner under my face. It was down on the day, and it had a downward trend. And so I waited till 9:35. Between 9:35 and 9:37 is the best time to enter, in my opinion, because you can start seeing this downward trend. We had a bit of a pullback here on this green candle, and so that's my enter at the top of this green candle or somewhere therein. And then immediately I saw a dramatic increase in the value of my contract. Of course, I had some pullback here, And by this time, the second drop, I think I had closed out for my 25%. So, yes, I was aiming for $15. That's only 15%, but I think I got 25 on that one. Yeah, okay, so that's it for that one. This isn't rocket science. I mean, anybody can look at this chart and see exactly where it's going. The point is, if you're looking at the first 5 candles, can you determine which direction that's going? We can see pre-market it did shoot up a bit, but overall it was very quickly down on the day. So it wasn't, again, it's not rocket science to identify it. It's all about timing. I guess I should note there, I'm not sure how much I've discussed this before, but when you're entering, it's all about your entrance. So you want to get it as close to the bid price as you can, and even below that. So your money is made on your entrance. If you have a terrible entrance, there's no way you can come back from that. So always make sure you're using limit orders and not taking market orders, and you're getting as close to the bid as you can. Okay, same thing here. Qualcomm is up on the day. I'm not sure how far they were up. They were probably only up 2 or 3%. Basically right away, they were up pre-market. We have this huge drop, and of course, I'm not going to buy in these first 2 candles because I'm not sure where it's going to go. By the 5th candle or so, I'm confident. Now this one, I'm pretty sure I bought it right at the line, so I had already missed these 2 or 3 pretty big pumps. So I got in here, and then there again, I have $100 in, I'm looking for $15 or $20, and that was just this range right here. Now here we can see it's starting to top out, and so I want to get out at that point because I don't know if it's going to turn around on me and come back down, or stay there, or go up. But either way, I'll take my wins, and I'll just be happy that that's what I have for the day. So again, the platform here is Thinkorswim. This is the desktop version, and I have the 1 day, 1 minute. And I'm zoomed in pretty far, so I can see, now this is zoomed out because this is later in the day when I took the snap. But while I'm trading, I'm zoomed in pretty far, so I can see just how much volume I'm getting, and the move within the minute as it's going up and down. All right, so that's this week's video. I did a little bit earlier because of Thanksgiving weekend. I'll probably go somewhere for the weekend, so I thought I'd get this out a little bit early. But I do have a video planned for every Friday, so check back next Friday. If you could, it would really help to like the video and comment if you have any questions. I'll definitely answer those. I do have links in the description. And lastly, my website is stacytracker.com. I'm a huge, huge, huge believer in tracking your trades, whether it's day trading or swing trading. You need to know what you're doing and what you're doing well, what you're not doing. And you can't do that without tracking things and then contemplating what you did right and what you did wrong. That's how you get better. So it's been a constant process for me to look at what I've been doing and continually refining. Obviously, you'll basically never stop refining, and that's part of life. So if that's something you're interested in, we can track all your trades. That's $9.99 a month, and there's a free demo, so there's no harm in checking it out. Anyway, that's everything. Thanks, guys.